Okay, and now let's do the share screen. Second. Do you see my screen?
Yes.
Great. Okay, so I will speak about Zim Shipping. It's a company that I recently found out. Let's get started. Okay, so first of all, a disclaimer. This is not an investment advice. I'm sharing my research. I might be wrong about stuff. That's it. Okay. Zim Shipping. So Zim was founded in 1945 as an Israeli national shipping company. The company operates large ships that are shipping containers. In this industry, they speak about 20 feet equivalent unit, or TEU. The company has 100 container ships. It doesn't own them, it just operates them, and we will see why it matters. The company right now actually only owns one ship. The company also have 740 containers, or at least TAU, because some of the containers are 40 feet, which is double, so it's half the number. The company is listed in the NASDAQ. It was listed in Tel Aviv, and it changed the place it is listed to the New York Stock Exchange. And one more thing, the company was government owned until 2004. Interesting. Oh, it takes me to the other way. Interesting. Okay, let's talk about the stock. So the first thing I have to say about it is that the company had 2 rounds of debt restructuring, and we'll see soon why it matters. This thing happens when a company cannot pay its debt, and then the people that they own the money to, or the company that they own the money to, gets part of the equity in the company. So during 2 financial crises in 2008 and 2014, the company lost some of its equity to the debt holders. The current market cap is about $7 billion, and the current PE is somewhere between 1 and 2. And we'll soon see why I'm not giving just one number. And it is planning to distribute between 30 and 50% of the earning of 2021 as dividends in 2022. And if you think about it, if a company with a PE of 1 distributes 50% of the earning of the PE as dividend, it becomes a PE of 0.5 immediately, which is crazy. But we'll soon see a few, like, we'll speak about it. But originally, this is the reason I was drawn to research this company. Okay, if we look at the income for past years, we see that the company pretty much breaks even in most years. So it didn't make any money in 2019 and 2018. You can see the net income, the last line, minus $1 $120 million, minus 13 million, and suddenly in 2020 it started making a little bit of profit. If we would look at the quarterly numbers, we'll see that the first half of 2020 was also pretty much break even or losing a little bit, and then in the second half it started making money. Then we ask ourselves what happened in the first half of in the second half of 2020, and this is what happened. This is an index of shipping prices. If we look at January 20 up to that point, the price of the stock was the shipping price for one container was pretty much $1,500 or something like that. Starting January of 2020, the price went up a little bit to the maybe 2,000 range, and in the second half of 2020, it came to the 5,000 range, which is pretty crazy if the expenses, if the company pretty much breaks even at 1,500, the fact that it can sell the product for 5,000 is crazy. Now, the next thing that happened, if we look at the current prices, so the last graph was up to last February, and it ended in 5,000. The current graph, like the current price is 10,000. Okay, so pretty much the shipping prices are going crazy. I added a few lines here to make it easier for me, but my basic assumption about the company, or basic understanding from these graphs, is that somewhere along, like under $2,000 per container, the company is break even, and now it sells the shipping services for 10,000. So it makes lots of money, and we will speak about it a little bit. The current earning numbers that we have for the first half of 2021 is for shipping prices of between 4,000 and 6,000. And we don't have the numbers for the third quarter of 21, but the prices for shipping went up significantly since then, so it's good for us. This is the quarterly earnings. If you look at the earning per share, we see that just like the graph of shipping prices went up, we are up to $7.38 per share for one quarter, and the entire share price is $60. Yes, the share price is $60, and the company makes more than 10% of that in one quarter. And this is in this quarter, okay? In the third quarter of 21, I'm sure that the earnings will be much higher. Okay, let's talk a little bit about that number, that 10,000 number. So first of all, the company is speaking about TAU, so 20 feet unit equivalent, and the graph I showed you is the shipping price for 40 feet container. And one more thing we can see, this is a different index that is showing the prices, but as we can see, the price of shipping changes between locations. So Shanghai, Rotterdam, we see that in one direction is about $30,000, and in the other it's about $1,500. Why is that happening? Basically, when a company is net importer, when you ship something with containers, the company must make sure that the containers will be back at the original place that they came from. So if in this route of Shanghai, Rotterdam, there is a lot more demand for shipment from China to Europe rather than the other way around, so we see it in the shipping prices. What else is very interesting in this slide is that in the past year, the prices of a few of most routes went up hundreds of percentage, and the two highlighted routes are the routes that Zim is mostly focused on. So mostly from Asia to America, United States. So geography matters, and the price of shipping is determined like by the direction that you need your shipping from. Like for a lot of shipments, the ships are carrying empty containers on the way back, which is something that we need to know. Okay, so let's talk a little bit about the industry and the product. So as you might assume, nobody cares who ships their containers. Everyone cares that just get it from point to point as cheap as possible. I don't care how, I don't care if you use a teleport, if you use a train between two ports, if you just make sure it gets from A to B. Zim is not only providing the sea shipping, it's also providing with sub contractors shipping via land. So it makes the entire route from A to B, and not only from the seaport to seaport. So as I said earlier, Zim only holds one ship, and it leases the rest of its ships. This is good and bad. We'll see why soon. But we need to know that some companies own their fleet, and Zim decided to be more agile and not buy the ships, or it sold its ships and leased them. One more thing that we know about this industry is that companies are leasing spots to get more flexibility. So let's say that one of its competitors is sailing between two ports, and Zim only needs 10 containers in this route. It might just lease the spot on the ship instead of sending its own ship. So all of the companies in this industry are doing that. They're also leasing containers, sometimes one way and sometimes two ways. Like it might lease one container from Shanghai to Rotterdam, and then return it to the company that leased it in Rotterdam. So this entire industry is very, very complicated logistics management, like management of resources, of which ship I will send to which route, how big is the ship, how many containers I have, where do I send them, etc., etc. So let's talk a little bit about shipping prices. So there is a trade-off in labor cost and shipping costs. So let's say I'm making pasta or clothing or whatever. I can make it cheaper in a different country and pay the shipping prices, or I can make it locally and pay less shipping prices. So the price of labor should impact the price of shipping. Okay. Another thing that I learned recently is that very, very low amount of labor is needed in shipping. So a huge ship with 9,000 containers on it only need a crew of 20. If you take this, let's call it $9 million of revenue, or 18 million, or 90 million, depending on the price, and divide it by 20, the labor cost is not there, is not meaningful at all. Yes, you still need a little bit more labor in the seaport, and you need a lot of logistics people. But then again, relative to the price of shipping one container, the price of labor is not meaningful at all. One other trade-off is that faster ships require more fuel per unit of volume or weight. But on the other hand, they can make more trips per year and pay the fixed cost of the ship faster. If you try to think about it, there are pros and cons to larger and to smaller ships. So larger ships are more fuel efficient and more crew efficient. So the same 20 people can operate a 3,000 container ship, or a 9,000, or maybe 12,000. So if you make bigger ships, you pay less for the crew. You also pay less for the fuel relative to the amount of cargo. On the other hand, some ships are too large for Panama, the largest size of ship that can fit the Panama route is called Panamax, and larger ships are called post Panamax. If you choose a larger ship that cannot fit into the Panama canal, you must take the longer route, which means that you spend more time on route. The pros for smaller ship is that you spend less time in the seaport loading and unloading, which means that you can make more trips per year, which means that you can pay the capital cost of the ship faster. In addition, we've seen that in the index, we've seen maybe 4 or 5 large hubs of shipping, like one in Europe, 2 in America, 1 in China, and that's about it. The reason is that those ports are huge, with deeper ocean floor in that area, which means that larger ships can fit there, which means that the entire shipping industry has become dependent on these few hubs, and from there there are other smaller ships that sail. The last point is that the canal tolls, so Panama and the one in Egypt, I forgot its name. Suez, the tolls there, it's pretty much like a toll road, and the price is fixed relative to the size of the ship and not to how full is it. The reason I told you all of this is not because I think you should care a lot about it. It's to show that there is no right size for ship. Like it's super complicated. It's like the chaos theory, where if the price of fuel goes up, you should go for larger ships. If it goes down, you should go for faster ships. If it goes if the price of labor goes up or down, it changes the optimal ship. And I don't think that anyone can predict the right kind of ship to buy. And most companies are buying these ships, and then they are fucked with them. Why am I saying that? The market is super cyclical. So first you see high shipping prices like now, and all of the companies are buying lots of ships using debt, which leads to over expansion and to more capacity than demand. The problem is that every company is expanding as if it's the only company that is expanding. Nobody is looking at the other companies and expanding relative to them. Everyone tries to capture all of the market. Because of that, these companies are taking a lot of debt in good times, and in bad times they must pay back their loans. So after everyone has bought new ships, everyone is trying to sell shipping services for losing prices, and it's a race to the bottom, just paying off the debt of the acquisitions. The next step is that because the companies cannot pay all of their debt, which is exactly what happened to Zim in 2008 and 2014, the debt owners become part owners of the company. Okay, when you buy bonds of a company and it cannot pay its bond, usually you get a part ownership in the assets. So either the ships themselves or the company. This leads in bad time to scrapping of older ships and to take them as scrap metal. And the next stage of the cycle is low capacity in the market, which is pretty much where we are standing right now. Because of that, because of the complications of the macro, as I said, I don't think that anyone can predict the right fleet. How do you build it? How do you the optimal size of ships, the optimal number of ships? And because the system is so fucking complicated, and the shipping prices of the more expensive routes impact the prices of the less expensive routes, because you can use the same ships, you can channel you can send them to the more expensive routes. Because of that entire field is build upon macro prediction. You need to balance the fuel cost, the labor cost, the import cost, the tariffs, the trade agreements between China and America, the government spending on ports. One more thing is that as the body that builds these ports that needs to be large enough is mostly the governments. And if, let's say, France will build a better port than Rotterdam, maybe the ships that are going to Rotterdam will go to Nice instead, or to wherever city in France instead. So it's super complicated with lots of second and third order effects. In my opinion, the only solution for that kind of complicated market is to not buy the ships, but to lease them, or to keep a lot of flexibility. Maybe you lease some of your fleet for the long term and some of it for short term, depending on prices of leasing, depending on other stuff. But in my view, like buying ships with debt for 20 years is crazy because of the cyclicality of this market. Wait. Yes, one more thing about market cyclicality is that Zim just ordered 15 new ships. They are leased, they are not bought, but they will arrive at the end of 2023. They ordered them at the beginning of 2020, so, or at the end of 2020. I assume from that it takes about between two and 3 years to build a new ship. Maybe that shipbuilding company had some kind of pipeline before Zim bought or ordered these new ships. So I assume between two and 3 years, which means that once the market, the competitors in this field will see that the prices are going up, it can take between two and 3 years for the prices to start going down. So let's say in the beginning or middle excuse me, at the end of 2020, companies saw that they need new ships, that they bought new ships. At the end of 2022 or 2023, we should start see the shipping prices decrease, and the cycle should take at least two or 3 years from peak to peak, or from bottom to bottom. Okay. Another thing is that iron is at peak price right now, and I think it's a huge part of the shipping of the price to make new ships, but I didn't check it. Like I might be wrong about that. One more or a few more things that you need to know about the company is that when the government sold its share of the company to private investors, they kept a golden stock. What does that golden stock means? It means that the company has a few conditions. The first one is that the CEO must be with Israeli citizenship. The second is that the majority of the board must have Israeli citizenship. The government may veto the transfer of controlling powers. So if somebody has more than like most of the stocks, and they want to sell them, the government may veto the sale of this stock. It cannot affect smaller investors, but just so you know, the company must hold 11 seaworthy vessels at all time. Currently, this is waived. And if a huge war will start in Israel, the government might call in the ships as a reserve duty to supply Israel with supplies. Currently, the company is not shipping, or almost not shipping anything to Israel, like it's mostly America, China, a little bit between China and Europe, some America, Europe, but almost none of its capacity is in the Israeli market right now, which is good because it's diversify the source of income. Risks. Okay, so as I said, in my opinion, it will take at least 2 more years until we will see the over supply in the market. But this kind of a play is a timing play. So currently the shipping prices are going crazy, but the market knows that it will not go crazy forever. In my opinion, the market is a little bit too, how do I say it? The PE of 1 is not justified for that. By the way, I didn't tell you, but I got to the PE of 1 by doing some black magic over the amount of shipping, like the capacity of shipping that the company had in the past quarters. I multiplied it by the new average shipping price for the third quarter, and my estimation is between 1 and 1.5 billion earnings, so profit, for the third quarter of 2021. The analyst estimate is about 1 billion, and I think it's the lower end of the range. Anyway, risks. So once the shipping prices will go down, the price of the stock will go down, I assume. In my opinion, this company is betting that the COVID disorder in the world will continue for more time than the market thinks. In my opinion, it will take at least 1 more year until the world will be back in order. And even then, I'm not sure that the shipping prices will go back to the original 2000 or 1 point something thousand prices. Yes, but it's essentially a bet on shipping prices. It's like buying a gold mine while the price of gold has skyrocketed. And one more thing, the company leases ships. Most of the leases are for short term. As we said, it gives it a lot more flexibility, but when the lease prices, when the shipping prices is going up, the lease prices might also go up, which might eat some of the profit. I don't think it matters in the current market, but I do think that the company has enough competitive edge to make a lot of money right now. So further research if you are interested in the company or in the field. So the first one is the report from Zim. The annual report from 2020 is online. You should read it. It's almost 200 pages, and it's a bit too long with everything bad that might happen, but it's good. The second resource I used is I read this book about the container industry, which was interesting. It had a bit too much of history about labor power struggles and strikes and all of this shit, but it had a lot of interesting knowledge about chips. And the third one, I think there is another company with a very similar profile, Danus. It's also traded in the New York Stock Exchange. I didn't look too much into that, but it's similar size, and it also operates container ships, and it might have the exact same profile and risk reward. It also holds 9% of Zim. Conclusions. So first of all, this is cyclical company. So yes, it's a PE of between 1 and 2, but it's essentially betting on the cycle. It's a bet that this cycle will continue for at least 1 more year. It's a bet that the COVID disorder in the world will continue. Without saying anything about our opinions about COVID or government, in my opinion, it will take at least 1 more year until we will be after this shit, but we will see. And one more thing is that a very fat dividend should come from this company in March of 2022. Or at least that is what the company is saying. I think we have a nice option play here, because when you buy a put option or a call option on the company, it doesn't take into account the reduction of stock price that will happen once the company will pay a dividend. So if the $60 stock pays $20 dividend, the options will not compensate for that. So if you can buy put options for, let's say, 50 for the strike price of $50, and you pay only $5 for that, and then the company pays $20 dividend, then suddenly your put for $50 is worth at least $10. Okay, so it's pretty crazy. I assume that the market will know to price it, but we should keep an eye on that. It might be a good investment. Besides that, the company itself, like the fact that it's just a PE of 1 or 2, I think it's pretty crazy, and I think that the market is not pricing it right. That's it. I'm stopping the